I also want to congratulate you for taking the first step in your trading success by getting my course. I know there's a whole lot out there in terms of education to choose from. I would just like to thank you for trusting in me. I know you won't be disappointed. I'm 100% certain that what you're about to learn will make you a better and more successful trader. I've been doing this now for over 16 years. In fact, my father introduced me to this business back in 1987. I traded through college, and that's what I've been doing ever since. So, I know what works and what doesn't. And what you now have in your possession works very well, as long as you learn and apply what I'm teaching you. I know some of you may already feel overwhelmed with the material by first reading the comprehensive manual. The comprehensive manual covers everything in the course. It gives you a great foundation of what you need to know before you watch these videos or DVDs. They will help streamline and put everything together for you in a very easy-to-use format. I will specifically show you exactly what you need to know and how to apply each trading strategy, section by section in the same order as it's presented in the comprehensive manual. Then, in the last part of these videos or DVDs, I will show you charts showing actual trade setups from beginning to end of each trading day shown. This will help put everything together for you on live charts. Before we start, I also want to make it clear to you that what I'm teaching you here in this course can be used in any market and any time frame. So you're not just limited to day trading the E-minis or S&P 500. I know most of you plan on day trading the E-minis or the S&P 500, but just realize that as long as you can chart the market you want to trade, what I teach can be used with great success. Okay, let me quickly discuss what we'll be talking about here in these videos or DVDs. The first thing we're going to be talking about is an overall checklist of what I teach, and that consists of the trend strategies and the counter-trend trade strategies. Second, price action analysis. Third, the close open system. Fourth, the market flow analysis method. Fifth, Fibonacci retracements. Sixth, how to enter the overall trend. 7. Trend analysis, a conflicting trend reading. 8. Trade management. 9. Time of day. 10. Coming into a new trading day. At the back of the manual, you'll find each one of these 10 sections that I'm going to be discussing. I encourage you to follow along with me as I talk about each one of them. Alright, the first thing I'm going to discuss today is trend and counter-trend trades. This section is meant to help simplify and put everything in order for you. Everything that you've already read in the comprehensive manual will be discussed right now to make it easier and to simplify it for you. So, first thing is let's divide what you've learned in two separate sections because they're two separate type of trading strategy. Over here on the right side are the counter-trend trading strategies. Actually, there's only one counter-trend trade strategy that you need to be aware of. Second part of the equation is the trend trades. Okay? Completely separate, have nothing to do with one another. Counter-trend trades can only occur when the market is testing a high or a low. Okay? We're talking about the high of the prior day or the current day. We're not talking about active highs or active lows or pivot highs or pivot lows. These are major highs or lows. So you cannot have a potential counter-trend trade setup without it testing a high or a low. All right? So the things that you're going to be looking at when the market's testing the high or low are these. The two indicators that I talk about are stochastics and RSI. They really have nothing to do with trend trading. You're only going to be looking at the peaks when the market's testing the high or the troughs when they're testing the low. RSI is pretty much a mirror image of stochastics, by the way, so really RSI is optional. Stochastics is really what I prefer these days. Okay? And so the second thing is what I call the 1-point rule. If the market's testing a high or a low, you do not want to see the market take out that high or low by more than a point. If it does, then you're not expecting a potential counter-trend trade. So I call it the 1-point rule. The most important thing that you absolutely need to see when the market's testing the high or low is what I call, the reversal patterns, which is like price action analysis. The three patterns are these. You need to see one of them, obviously, only. Okay, so when the market's testing a high. You're looking for either a double 3-minute bar high with the lower close, that's one pattern, or you're looking for a bearish outside vertical bar with the close closing the bottom quarter. Same thing with the double 3-minute bar high with the lower close. The close absolutely must be closed, it must close in the bottom quarter. Or the third pattern is what I like to call a variation of the double 3-minute bar high. So they may not have to be two consecutive. You may have a couple bars in between and the last bar closes lower in the bottom quarter. As long as that last bar is lower than the bar before it's low. Those are the reversal patterns I'm looking for. So if you see one of those patterns testing a major high and the market is not able to take out the high it's testing by more than a point, as long as it's a point or less, then you've got a counter trend trade set up to go short. Okay? So this is your actual trigger. Okay? Your reversal patterns are your trigger to actually enter the market short. When testing a low, it's just the reverse. A double 3-minute bar low with the higher close, or a bullish outside vertical bar, or a variation of that double 3-minute bar with the higher close. You need to absolutely see one of those. Without that, there's absolutely no potential trade setup. And then the next thing we're looking at is obviously what time of day is it? Okay? So let's talk about time of day just real quickly. And again, later we're going to talk about time of day a little bit more in depth here. But at 10:30 a.m., Eastern Standard Time, depending on what the trend of the day up until that point is, you're looking for a potential counter trend trade. And again, a counter trend trade is against the current trend. So let's say the market opens up, drops down 4 or 5 points, puts in a low, and it's in and around 10:30, give or take 15 minutes, you're looking for some type of movement to the upside. Okay? There's 2 more times a day where you'd expect a potential counter trend trade. That's at 2 o'clock and or 3 o'clock. If at 2 o'clock and the overall trend of the day is up, okay, and the market's testing the high and it's near 2 o'clock, you're expecting a minimum of about a 40% retracement of the overall day's uptrend. But remember, you can't have a potential counter trend trade unless the market is testing a high or low. Okay? So at 2 o'clock, you're looking for either a counter trend or a resumption of the day's trend. At 3 o'clock, you're looking for either a resumption or a counter trend trade. So chances are if you get a counter trend move at 2, then at 3 o'clock, you'll probably get a resumption if it sets up. If at 2 you get a resumption, then at 3 you would expect a potential counter trend. But again, only if it sets up. So out of what I just discussed, you need at least, you absolutely have to have the reversal patterns that I discussed here. Without it, there is no trade. If you've got everything else set up, but you don't get the price action, the reversal patterns, down off a high or up off of a low, there's absolutely no trade setup. Okay? And remember, don't confuse the counter trend strategies with what I'm going to talk about next, which are the trend strategies. Completely separate and independent. Okay? So let's talk about trend, and this is in the order of significance. Okay? What determines trend? You've already read the market flow analysis method. That's number 1, the MFAM, right? And that's simply defined as higher highs and higher lows, right? The higher lows I call active lows. And in a downtrend, lower highs and lower lows. I define those highs as active highs. And again, we're going to get into more details when I talk about that in a few minutes here. Number 2 is Fibonacci retracements. Okay? The Fibonacci, as you'll soon see, the Fibonacci retracements fit beautifully with the market flow. As the market's going up, the market's always retracing somewhat. So they fit beautifully. So as you already know, we use the 40%, 50%, and 60% retracements. Another concept that you've already learned that I'm going to discuss a little bit later is Fibonacci confluence. So the market flow, higher highs, higher active lows, they all fit together. So the market doesn't go straight up without pulling back off the high somewhat. Once again, we're going to talk about that a little later. Number 3 are the Keltner channel bands. Okay, the Keltner channel bands, as you know. And let's just summarize those real quick. In an uptrend, when the market's making higher highs and higher lows, you're looking for between the mid to the lower Keltner to act as support, which is synonymous with potential buys. In a downtrend, you'll notice that the upper, mid, and lower Keltner will be slanting down with price. Obviously, the market will be making lower highs and lower lows. Therefore, when the market reacts and or retraces back to between the mid to the upper Keltner channel band, that's resistance, potential sells, okay? let's see. And then we also talk about a concept, upside mid-Kiltner penetrations through the moving averages and downside mid-Kiltner penetrations through the moving averages. And that, of course, is a subcategory of the Kiltner channel bands is the 79 simple moving average and the 89 exponential moving average. Without the use of the Kiltner channel bands, the 79, the 89 mean absolutely nothing, okay? So what you need to see here, in order to utilize the 79, the 89, the mid-Kiltner must cross up through both of the moving averages, okay, for an uptrend to be intact, along with the market flow method. The opposite is true. If the mid-Kiltner crosses down through both of the moving averages and the market flow is down, the trend is down, okay? So this is in the order of significance here, remember. Number 4, again, we're going to talk about time of day a little later in more detail, but it's also on this side of the equation, okay? So time of day, we're going to skip the 10:30 in the morning because we're on the trend side of the equation, not the counter trend. The 10 o'clock, you're expecting a counter trend of the first hour's move if it sets up. The time of day on the trend side of the equation would be from 1:15 Eastern Standard Time to 2 o'clock, what I call the post-lunch move. So you go away to lunch, 12 to 1 o'clock Eastern, market's been up pretty much all day, you come back from lunch and the market's trading down off the highs in an overall uptrend, you would expect the market to resume back up towards the high of the day. The same is true for the reverse scenario. If the trend is down, market's coming up off the low of the day, and it's in a technical area where you'd look to short, you'd expect a resumption back down. So that's 1 to 2. Then we're going to go to 2 o'clock and 3 o'clock. So this could happen, you know, near 2 or at 2. You're expecting the same things, either a counter trend or a resumption of the day's trend. Okay. So if you get counter trend, expect probably a resumption. If you get a resumption, expect a counter trend. So on this side of the equation, we're going to circle the resumption because that's along the lines of a trend. On this side of the equation, the counter trend, we're talking about counter trend, so we're circling the counter trend. So this is meant to help put everything in perspective. This is really the crux of what I teach. Okay. The last thing that I want to mention on the trend side of the equation is, again, price action analysis. And again, these are pretty much the same as the reversal patterns that I showed you over here. The difference is these 3 reversal patterns, right, when number 1, 2, or 3, or 1, 2, and 3, when testing the low, they're the same patterns. The only difference is when you're in an uptrend, okay, when you're in an uptrend and the market pulled back to a support level where you'd be looking to buy the market, you would be looking for either a double 3-minute bar low with a higher close, that would help confirm the trade to go long, or you'd be looking for a bullish outside vertical bar, that would help confirm going long, or if you get some type of variation of the double 3-minute bar low with the higher close, that would help. So I'm going to add price action on this side of the equation only when the market is in a trend. So what this is, meant to do is just to, again, put everything together for you to make it a little bit more easier. Now what I'm going to do is I'm going to go through each section of the manual and show you exactly what you need to know and how to trade the specific trade setups. All right, now what we're going to discuss is the comprehensive manual in order of the manual. And the first thing I talk about that you probably feel a little overwhelmed right now with is price action analysis. As you already know, I've talked about 9 types of vertical bars. Just let me assure you that you don't need to be aware of every single vertical bar as it's coming to you live as the market's trading during the day. Not at all. That's not my intent there. My intent there is to, familiarize yourself with the types of vertical bars and what to be aware of. But now I'm going to tell you exactly what you need to know if you're going to day trade. Coming into each trading day, you just want to pay attention to what the prior day did in terms of a daily vertical bar. And what you want to pay special attention to is the close. Only 2 types out of the 9 types of vertical bars I discussed, the bullish vertical bar, the bearish vertical bar, the neutral vertical bar, the outside vertical bar, the expanded range vertical bar, the inside, the reversal bars, inside, weak range, all those, that's fine and dandy. But the 2 that you want to pay attention to is the bullish vertical bar, where the close is in the top quarter of the range. You really don't care where the open is because close denotes price action. Okay? If close is in the top quarter, there's a potential trade setup today, coming in today. The second vertical bar is just the opposite, the bearish vertical bar, where the close closes in the bottom quarter, okay? If you get one of these setups the prior day on a daily bar, so you come in, it's 9:30 in the morning, Eastern Standard Time, and you look back and yesterday was a bullish vertical bar, there's a potential trade setup based on price action. Now what you need to see to get the trade setup is a down opening. So if the market opens up lower, but at or above the 50% retracement of the day from high to low, there's a potential trade setup, right? So it opens up lower. Now what you're looking for is the market to move down into some type of support area where you'd be looking to buy the market. So let's say the market opens up, kind of comes down a little bit, you know, back to like, let's say the 79, the 89 moving average on a 3-minute chart if you're day trading, you know, somewhere between a 40 and a 50% retracement from the day's high to low. So it opens up lower, backs up into support, you'd be looking to buy the market there. That's it. That's what you're looking for this potential trade setup. So when you get that, you're looking for the market to bounce, right? To bounce back up, to potentially test the close of the day, and then potentially the high. That's all you're looking for. So the reverse scenario would be it closes down, today opens higher, at or below the 50% retracement from the high to the low, okay? If the market rallies somewhat, you're going to be looking to sell it into that rally, into resistance, which, as you know, is synonymous with selling the market. So a few things you're looking at here. Looking at the 40%, you know, between the 40 and the 50% from high of the day, the prior lower day. And you're looking at the moving averages, the 79 simple and 89 exponential moving average. So the market rallies up into this area. You're looking to sell the market short, anticipating the market to come down, test the close, and or test the low. So you're looking for some type of movement back down towards that close. That's all you're looking for on this potential price action. That's it. So if when you see a bullish vertical bar and the market opens up unchanged, if the market opens up unchanged or higher than where it closed, there's no trade setup because it's got to open up lower. So there's the two criteria you need to see to have a potential trade setup. Got to be a bullish vertical bar, and it's got to open up lower, but above the 50, and then drop into support. That's it. But if it opens up unchanged or higher, no trade setup. Same thing here. If it opens up unchanged, meaning no, you know, pretty much right on the close, or even lower, there is no trade setup. It's as simple as that. So again, once you're watching the market during the day, you're not paying attention to every single vertical bar that comes your way. That's ridiculous. You only want to, coming into the day, you want to see what the bias is the first hour of trading, and that is for the market to fill the gap in the direction of the either bullish vertical bar or bearish vertical bar, okay? There's only 3 times during the trading day, if you're going to day trade, that you're going to pay attention to these vertical bars, okay? One is if you're, let's say, the first one is if the market's testing the high or low of the day. We just discussed that in the first thing I talked about, the 3 reversal patterns. So if the market's testing the day's high or the prior day's high or the low, then you're looking for either a double 3-minute bar high with a lower close, or a bearish outside vertical bar, or a variation of the double 3-minute bar high with a lower close. Or if it's testing the low, same scenario there. Second thing you're looking at is if the market's in an uptrend and you want a continuation signal. So if the trend is up, okay, again, just a really quick recap. The trend is up, market's pulling down, but you don't feel comfortable buying it automatically as it's dropping into support, and you want to wait for confirmation. One of those 3 patterns, either a double 3-minute bar low with a higher close, or a bullish outside vertical bar, or a variation. Okay? Right? That's one. And again, if it's testing the high of the day, the same thing, but reverse it. Double, and I just talked about that. The third thing is if you're actually in a trade. Okay? If you're in a trade, let's say you're long. Okay? You're long the market, and you see a bullish outside vertical bar. Again, you know what the definition of an outside vertical bar is because you've read the comprehensive manual. If you're long, market's coming down and you go long right in here, and you see, let's say, a bullish outside vertical bar, I would immediately move my initial stop loss up to below the low of the outside vertical bar. ISL stands for initial stop loss. You already know that. We're going to discuss that later on in trade management. Okay, so that's what I would do there. Or if I'm long and I see a bearish outside vertical bar, the opposite, the high and the low exceed the prior bar's high and low, and it closes in the bottom quarter, I would exit the trade immediately. So just reverse it. If you're short, you're going to be doing the same thing. If you're short, you see a bearish outside vertical bar, you're going to immediately bring your initial stop loss down to above the high of the vertical bar. If you're short, but you see a bullish outside vertical bar, you're going to exit immediately. Those are the only 3 times that you would use price action on your intraday chart for day trading purposes. That's it for price action analysis. That's all you need to know to trade using price action. All right, what we're going to discuss now is the close open system. All right, this section comes right after the price action analysis. Remember, this has absolutely nothing to do with anything else that I teach. This is a complete separate and independent trading strategy all by itself, based on the mentality of floor traders. Has nothing to do with the Kiltner channel bands, the market flow method, Fibonacci retracement. Has absolutely nothing to do with what we just discussed, price action analysis either, okay? That's what you need to be aware of. Standalone trading strategy. Very simple principle. Very, very easy to understand. Again, nothing to do with price action, so you don't care where the market closed the prior day. So you're going to take the 4:15 Eastern Standard Time close of the prior day, and you just want to see where today opens to give you a potential trade setup. So let's just say yesterday closes at 11:36 3/4. One other thing I want to add, this strategy is only good for E-mini or S&P 500 traders. I've never really looked or experimented with this on currencies, stocks, or anything. Only applicable to E-minis or S&P 500 day traders. Okay, so let's just say the prior day closed at 11:36 3/4. In order for you to get a potential trade setup for a buy, so this is going to be a buy example. We're going to do a buy example first, okay? If it closed yesterday at 11:36 3/4, the market has to open up a minimum of 2 to 3 points lower than the prior day's close to get a potential buy up through the close. So let's just assume the market gaps down and opens at 11:33 3/4. Okay? That's where the market opened. So it opened up down 3 points. Now there's a potential trade setup to the long side only if the market rallies up and takes out the prior day's close. So let's say it opens up, kind of comes up a little bit, and then it rallies up. You're going to be looking to buy the market at 1 to 2 ticks higher than the prior day's close. Remember, you never want to buy or sell on halves or rounds. Since the market closed at 11:36 3/4, your buy would come in at 11:37 1/4. That's 2 ticks above the prior day's close. Remember, the E-minis trade in quarter increments. 11:36 3/4, the next one up to 11:37, then 11:37 1/4. Most of you already know that, but just a quick recap. So, market opened up down. If the market never rallies back up through that close, there's no trade setup based on the close open. But if the market rallies up through the close, you'd be looking to buy the market, and you'd use a stop order. You know, it'd be a buy stop at 11:37 1/4. That's as simple as that. That's all it is. So for a buy trade setup, utilizing the close open system, the market's got to open up a minimum of 2 to 3 points lower than the prior day's close. Now you may be asking, well, where's your profit objective? Where's your initial stop loss? Well, once you enter the trade, you would immediately want to put your sell stop, which is your protective stop, below the lower Kiltner channel band on your 3-minute chart. Simple as that. All right? So your initial stop loss when you enter the market, when you buy, is below the lower Kiltner on a 3-minute. Below lower Kiltner on the 3-minute chart. Simple as that. So you say, where's my profit objective? Real simple. Profit objective is 2 to 3 points, that's all. So you're not looking for a whole lot in this trade. Some of you may be looking for more in a trade. So if you do that, you could utilize a trailing stop. And we're going to get into a great trailing stop later under trade management. So that's it. That's a buy setup. Let's do the reverse scenario. A sell trade setup based on the close open system. Okay? Let's use the exact same numbers here. The market closed yesterday at 11:36 3/4. Let's say the market opens up at 11:39 even. Market opens up 2 1/4 points higher. So that meets our criteria for a potential trade setup. So if the market opens up and then comes down, okay, you'd be looking to sell at 11:36 1/4 on a sell stop. So that'd be a sell stop, right? Simple as that. Market opened up higher. So if the market comes down through the close, you're short. Your initial stop loss here is the opposite of a buy. Instead of placing it below the lower Kiltner. Since you're going short, you're going to place your initial stop loss above the upper Kiltner channel band. Okay? So it's above upper Kiltner band. Very easy. Profit objective, the same thing as over here. 2 to 3 points. Quick profit. That's it for the close open. There's nothing more than that. So just remember, this has absolutely nothing to do with anything else that I'm going to teach. Market flow, Fibonacci's, price action analysis, Fibonacci's, retest failures. Nothing in the course has absolutely nothing. This is just a standalone trading strategy. So we're done with this. All right, the next concept I'm going to discuss is very important. As you already know, the market flow analysis method, abbreviated MFAM, is what we're going to now talk about. And that's the crux of, the methodology that I'm teaching you here. Okay, it attempts to tell you when and where a trend begins and when it ends, and it attempts to do that at the very early stages. It's a very easy market principle to understand, so don't make it any more difficult than it is. Remember, the market either goes up, down, or goes sideways. And this little strategy here, this little analysis technique will help identify these patterns at the early stages. Okay? And the market flow also encompasses two very important market principles that you've already read about. That's the retest failure section and the Fibonacci retracements. They all go hand to hand, okay? They're all in alignment with one another. So let me give you an example right here, and then we'll define it a little bit. All right, this is obviously an uptrend. Very simple. Higher highs and higher lows. So LL stands for the lowest low. High number one. Low number one, right? Higher high, low. High number two, low two. So you're making higher highs and higher lows. Now, what I call lows in an uptrend would be an active low, but we've got to define these. We're going to define what an active low entails. Okay? An active low is supposed to be significant enough that if the trend is going to change from up to down, the market's got to take out the highest active low, and I call in the manual the most recent active low, which is the highest active low, okay? So look at this. The market makes higher highs and higher lows. Trend is up. So the other two market principles that I want to quickly discuss here are retests and potential failures and Fibonacci retracements. So look at, when the market comes down off this high, down to this level, and when it comes down from this high to this low, I mean, these movements here, those are called Fibonacci retracements, right? And we're going to talk about that in the next section after I'm done with the market flow, right? So market pulls down off this high to this low, rallies back up, takes out the high. That's a Fibonacci retracement. Same thing here. Now you've read about retest failures. Very simple, and I discussed that in the first section. Whenever the market comes back up to test the highest high, that's a retest. The market is retesting the prior high. Retest. It's retesting that high. Market comes back up here. The market is said to it's retesting this high. So when the market reaches this high, you have to ask yourself, is the market going to fail? If it's going to fail, there's a potential double top there. Comes up to this high, is it going to fail? So, and we'll go through the counter trend strategies a little bit later again, but I've already discussed them in briefly in the very first section of these videos or DVDs. So these are Fibonacci's, those are retests. Now let's define what an active low is in an uptrend, okay? There's three criterias in order for an active low to be established, okay? And they all have to be met. The first is that the market must come down far enough to consider it the potential active low, okay? So how I define, I'm trying to stay away from giving you exact point values because, as you know, the market becomes more volatile than less volatile. So if I give you a point value, as the market fluctuates in its volatility, those numbers will change. So what I'm going to use here to gauge how large of a pullback it is are the Kiltner channel bands. So as you already know, when the market is in an uptrend, right, making higher highs and higher lows, the Kiltner channel bands will also be going up. So the upper, mid, and lower Kiltner will be following price. So how I gauge to see if it's a big enough pullback is I need to see, so it's really a price and a time element. The first one I'm talking about is price, meaning the market's got to pull back far enough. So remember we discussed earlier, mid to lower Kiltner channel band in an uptrend is a potential support area. which is synonymous with buying. So what I need to see is for the market to pull down off the high between the mid to the lower Keltner band. So if that's the mid Keltner and that's the lower, I need to see the market pull down off the high between the mid to the lower. That tells me that the pullback down off the high is large enough to consider it an active low if the other two criteria are met. The second is the time element. Okay? So now we've had the market come down to between the mid to the lower Keltner. Now, time element means, again, if you're day trading, or if you're, it doesn't matter if you're day trading, swing trading, trading stocks, or any other market, you need to see a minimum of 4 to 6 bars in the pattern. Now, it could be 20, it could be 30 bars, it could be 5 bars. What I mean by that is when the market is coming up and pulling down off the highs, you need, in this whole pattern here, not counting the highest high, that's 1 bar, 2 bar, 3 bar, 4, 5, 6. Okay, in this pattern, that's 6 bars, so that meets our criteria. It's at least 4 bars. So what I'm saying is you just don't want to see like 1 or 2 bars down off the high and then market slam back up through the high. That's not enough of a pattern to consider it significant enough to call that an active low. But this is. That's beautiful. So we'll say that the time element, okay, there's 6 bars that create, that meets our criteria. Price, okay, it came down and the market dipped between the mid to the lower Keltner. Great. Those are met. Now the third criteria that completes the active low is that the market must come back up and touch this high. Okay? So it's right here. When the market matches this high, that's when the pattern is complete. Okay? So it's got to, test high that the market came down off of. Okay? So, if the market did, let's say the market came up but didn't quite come to that high. Let's say it did this. It dropped between the mid to the lower Keltner band, and there's 4 or 5 bars there. But it does this, and it does not come back up and touch it. That's not an active low. It's only an active low when the market comes up and touches that high. Boom, that officially becomes an active low. That's the definition. That's what an active low is. All right, we just talked about uptrends in the market flow. Now what we're going to do is just flip it over. Now we're going to talk about downtrends. So essentially what I just talked about, it's the same, but just flip. So let me draw you a diagram and give you an example. Market's in a downtrend, obviously, right? HH stands for the highest high, drops down to this low. Rallies up, it's in the high, comes down through this low. Low number 2, right?
It's called the price line.
Comes up, comes down through here. Now remember, this becomes an active high if our criteria are met. This becomes an active high. So active high 1, active high 2. All right, so you got lower lows and lower highs in a downtrend. Very simple concept, okay? The next section we talked about Fibonacci retracements, exactly how to enter the market exactly, but you need to understand this concept first. So downtrends. So again, let's define an active high. Same thing as an active low, but flipped over. 3 criteria. You've got price and a time element that you need to meet. Okay? Talk about price real quick. So in a downtrend, as we talked earlier, Keltner channel bands, when the market's making lower lows and lower highs, the Keltner channel bands are actually going to be coming down as well. The upper, mid, and lower Keltner are going to be going down with price. So what you need to see the market rally up off this low high enough, i.e. between the mid to the upper Keltner, that'd be the mid, let's say that's the upper Keltner for example purposes, mid to upper. The market's able to actually hit the mid and go slightly above it and then back down. That tells me that the market made a big enough bounce and or a big enough Fibonacci retracement to consider that as significant high in the downtrend. So price, you're talking the mid to upper Keltner band. It's got to go to, okay? Time, same thing as before, 4 to 6 bars in the pattern. So when the market comes up off this low, not counting the lowest bar, in this entire pattern, 1, 2, 3, 4, 5, 6, there's like 7 bars in that entire pattern. That meets our criteria, 4 to 6. Easy. The third criteria that actually completes the pattern to make an active high is the market must come back down and test this low. Okay? So when the market hits it, let's say on the 6th bar it hits that low, that officially becomes an active high in this downtrend. As you already know, if the market came down here and then rallied up and took out the high, the downtrend changes from down to up. But we're going to go over that next. Again, market drops down, makes a second low. Rallies back up, i.e. Fibonacci retracement, right? We'll talk about that next. As long as the market rallies up to between the mid of the upper Kiltner again, and there's at least 4 to 6 bars in the pattern, right? And the market comes back down and matches this low, that officially becomes active high number 2. So in that downtrend, in order for that downtrend to change from down to up, the market's got to rally up through that high, okay? And we're going to talk a little bit more about trend in a few minutes, but based on the market flow, this is a downtrend, and what I just previously talked about, that's what constitutes an uptrend, all right? One other thing, okay? The thing here is what you want to be aware of is other things like the 79 simple and the 89 exponential, but we're going to talk about that a little later. And for those of you that aren't necessarily going to day trade the E-minis or the S&P or anything, this exact principle can be applied to any market, any time frame. That's why I'm not giving you point values here. I mean, heck, if you looked at a daily stock chart, just fit in this criteria. You know, matching a high or a low to create an active high, price mid. Remember, the parameters that I taught you in the course, like the Kiltner channel bands and the 79 simple, 89 exponential, you can apply them to any market, any time frame. You do not have to use them for day trading purposes on the minis or the S&Ps. As long as the market that you're trading is volatile and liquid enough, the same principles apply. And so this concept can easily be universally applied. All right, let's briefly talk about an uptrend changing into a downtrend according to the market flow analysis method, and a downtrend changing into an uptrend according to the market flow method. Very simple. I think I touched upon it briefly just a minute ago, but real quickly. All right, market's in an uptrend, right? Real simple, right? Market moves from low to high, comes down, puts in an active low, right? Once it hits that high, that becomes an active low. High number 2 comes down to this. Active low 2 becomes an active low 2 when it matches this high. Now, for that uptrend to change from up to down, the market has to come down and break down through active low 2, the most recent active low. That's simple as that, according to the market flow method, okay? So when the market comes down and breaks active low 2, which is the most recent active low, the highest active low in the uptrend, once it penetrates down through this active low, this becomes the highest high in the uptrend. Now the trend changes from up to down. So now what you're doing is you're looking for the market to hopefully, pull back up, so you're looking to enter in there. And basically what you're essentially looking for is for the market to change direction from up to down. So the whole process begins all over again. Higher highs, higher active lows in the uptrend. Market comes down, penetrates down through this active low. Trend is now changed according to the market flow. Puts in a low, rallies up. This becomes an active high once this low is matched, minimum, with the 2 criteria that I just discussed, okay? Comes down to low number 2. This becomes active high number 2 once this low is matched with the other 2 criteria that I just discussed, meaning, it's at least 4 to 6 bars in this pattern, mid to upper Kiltner minimum to consider this active high, okay? So that is uptrend changing into a downtrend. Let's quickly do a downtrend changing into an uptrend. Very simple, okay? Again, the difference is, you're making lower highs and lower lows. It becomes an active high once this low is matched, right? Low number 2. This becomes active high number 2 once this low is matched or taken out to the downside. So this downtrend changes from down to up when the market rallies back up and takes out the lowest active high or the most recent active high in the downtrend. So when that happens, you're anticipating the trend to change from down to up. So this is, you're just looking for this pattern to occur, right?